I'm Dan, and the other person you see is Tim. So we're going to be the hosts of tonight's webinar or presentation. And what we'll do just to kind of go over a couple things here right off the bat. So first of all, we are recording this presentation, one of which because compliance requires us to do so. And since that requirement is in play, we will share this with you so you have it, and I'll pass it along to others that couldn't make this presentation to begin with. A few other house rules. In a moment, we're going to turn over to a disclosure. I know we don't want to have to hear it either, but it is the rules. It's how it goes. So we'll just need you to kind of grin and bear it with us, and we'll get through that as quick as we can. A couple other things, though, to note. So one of which is we do have the chat feature up. If anybody has any questions, you are more than welcome to put a question in there. We do have, at the end of this presentation, we'll leave some time for you to ask some questions. But as we've mentioned, and you've probably noticed, you are muted. So we won't hear you if you do talk. That's just so that we don't have any disturbances during the presentation. But again, we will see those questions. It is a small group today. So the advantage of that is, if indeed you have a burning question that you don't want to wait to the end, feel free to type it in and we can address it. However, if indeed the question is a specific question, we can't give any advice to a group like this. It has to be individualized. So if it's specific to you, just understand that we won't be able to answer that question. If it's general, no problem. You're more than welcome, though, to talk to us offline, and we're happy to address your questions if you would so like to, depending on the depth of that question. If indeed it means advice, it means we actually have to have a client agreement. So those are the house rules. And without further waiting, I know people are waiting for this. I'm going to pass it over to Tim to serenade us with this disclosure.
Yes. So we are going to go through the disclaimers, and I have to read this out loud for compliance because we are recording this, so please bear with me while I read through this. The opinions expressed in this presentation are for general information purposes only and are not intended to provide specific advice or recommendations for any individual, on any specific security, on any specific broker-dealer or custodian. It is only intended to provide education about the financial industry. To determine which investment, broker-dealer, or custodian may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this presentation is no guarantee of future results. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. All opinions expressed by participants in this presentation are solely their own and do not reflect the opinion of Leach, Bickmore, and Weiss Wealth Management, LLC. Leach, Bickmore, and Weiss Wealth Management, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leach, Bickmore, and Weiss Wealth Management, LLC and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Leach, Bickmore, and Weiss Wealth Management, LLC unless a client service agreement is in place. Whew, got it done. We're good.
Doozy.
Next.
All right, thanks for being patient through that. So I will mention, you probably have figured it out by now if you didn't know it, but the common phrase Tim said of Leach, Bickmore, and Weiss, that's LBW, and that is who you're talking to, or more commonly known as LBW. So I am the W, and Tim is the B of this entity. We found that firm 5 years ago. We're not here to talk about the firm, so this is going to be the only piece that you actually hear about the firm. We do want you to know a little bit as to who you're talking to, so you know we just didn't come off the street. But Tim is going to be doing most of the detailed conversation. It's most fitting. He heads up our financial planning division inside of our firm that we found 5 years ago. He does carry a CFP, which is a commonly sought after designation inside of our industry. And he also carries a CPWA, which is a certified private wealth advisor, allows us to get into much more detailed work that we find with high net worth individuals that we do focus on. That's coursework that he took that certification through Yale. So he'll handle a lot of that stuff. I'm going to be more of the ringleader for this. I've got the more fun job between the two of us today. So that's who you're talking to. The two of us are two of three founders of the firm. And the reason why you find us in front of you is because we're based in the Midwest in Madison, Wisconsin, but we operate all over the country and work with a lot of individuals at Netflix. So we're very familiar with the topic at hand, as well as other Netflix related concepts. So that's who you're talking to. And what we'll do is we're going to start this off by talking about what you have available to you. And what you have available as far as stock options are what's considered non-qualified stock options, or NQSOs. This is very unique to Netflix. We'll talk a little bit later as to why it is so unique to Netflix if you're not familiar, but it is. We don't see a lot of entities where this is their primary or entire way of operating stock options. And it really comes to you in two different forms. You get what Netflix refers to as free options, technically would be called granted options. All of you get this. So if you're on this call and you work for Netflix, you get granted options. They come 5% automatically every single month. It's part of your compensation package, whether you want them or not, you're going to get them. And yes, indeed, the money is real. So that's a joke, but we do actually hear from people quite a bit. Whoa, I've heard people talk about this. One, because they didn't know how to access it, so they didn't even know where to find what that dollar amount was. Or two, they really didn't realize that this is actually real cash. This actually is real cash. So that's that piece. We won't get into a lot of that today. What we really do want to spend more time on in this presentation is the supplemental allocation or supplemental options, because that does indeed bring in some risk that you don't see with the granted options. It's a bit more complicated, and we often find it very confusing for people, or people are confused about it, or they think that they're not, but they are, or vice versa. So we will talk about that in greater detail here in a few minutes, but just about how you elect and when you elect to do so. What it really means about this 40% discount, it is actually not a discount. We've argued that a number of times. We're going to do our best effort of explaining why it's not a discount, but what it really is, and really the risks and rewards associated. But before we get into any of that, it probably makes sense to talk about some terminology. Again, another very confusing element as it relates to your stock options is that a lot of phrases get thrown out there, and it'd be great to kind of go over, and this is going to be a mouthful, but go over just more of the common important ones so that we don't want anyone to get lost inside this conversation or not. And at this point, I'm going to shut up and let Tim actually go through these line item by line item. So Tim, the show is yours. Please talk to us about these phrases.
Thanks, Dan. Yeah, so this is going to be a mouthful, and I'm going to do my best to make it not so boring for people, and I hope people's eyes don't glaze over, but they are important terms. They're important terms if you're working with really any other advisor or any other person, just knowing yourself, because it really lays the foundation of understanding exactly what you're receiving. Really quickly, I want to just mention non-qualified stock options. The biggest piece that you really want to focus on there is the non-qualified piece. Because what that's really telling you is that the IRS is saying, hey guys, you get no tax benefit. We're just not going to give you any benefit. There's no incentive from a taxation standpoint. So that's really what it's focusing on when you're looking at non-qualified stock options. And that's why it's termed the way it is. So that's what you guys are receiving, either through the free 5% or allocating some of your salary to the supplemental allocation. So when I'm talking about this terminology, I am specifically talking about non-qualified stock options. But like we'll talk about in a little bit with other competitors or other tech firms in the area, you can see ISOs, RSUs, but we won't go into that detail. I just want to make sure that we're just focused on, again, those types of options. So the first line is really grant date. And grant date's important because it really sets the stage for a lot of this other terminology. So with Netflix, when you receive your 5% free allocation, you're going to receive that on a month-to-month basis. So for example, let's say that you started with Netflix in December and your free 5% starts in January. You're going to receive it typically at the first of every month. So let's say that on 1/1 of 2019, you received your first set of free allocation to you. That, when you receive it, that is the date of the grant. So that means that is your grant date. So 1/1/2019 is what would be considered your grant date. The reason why that's important is because on that date, it's going to then set your exercise price, which is our next line item. So the exercise price or grant price is going to be the price of the Netflix common stock on that day. Typically, it's at the close of trading. So again, in the Midwest, that's 3 o'clock, you know, and in the Pacific time zone, you're looking at 1 o'clock. So when the Netflix stock closes, that's what they're going to use as the exercise price or grant price, which is the same date. So to follow our example, if we are granted our free options on 1/1/2019, and let's say Netflix at that time frame was trading and closed at $100 per share, your exercise price or grant price would be $100 per share. And then that's how they're going to go ahead and calculate how many shares they're going to provide to you, which we don't need to get into the calculation. I don't want to bore you too much, but it is important to understand that. The exercise price and grant price are important because that's really going to allow us to understand how much of our stock option is actually going to be taxed, which we'll get to in a little bit. The next piece is vesting. I'll be honest, guys, the cool thing about Netflix is that you guys are vested immediately, meaning when it's granted to you on that grant date, there is no vesting period. And what vesting means is typically what employers will do is they'll set a time frame or they'll set a performance metric to these stock options. And let's say that time frame is you have to vest over a year, or you vest 25% of that granted option every quarter. Netflix actually doesn't do that. You get vested immediately, which means let's say you got granted on 1/1/2019 10 shares of stock, and on January 2nd you left Netflix. You actually can carry that over. It sticks with you for the rest of time, right? It follows you wherever you go because Netflix has allowed the vesting period to be immediate. So the vesting period is actually quite simple for Netflix qualified or Netflix non-qualified stock options. It's very simple. It's just once you get it, it's yours, nobody else's. The next piece is your expiration date. So the expiration date is really important for a few reasons, and I'll hit on that in just a minute. But the expiration date for the Netflix non-qualified stock options is 10 years. So using our example, we were granted on 1/1/2019 10 shares. That means those options will expire on essentially 12/31/2028. So full 10 years later, which means what Netflix is telling you to do is like, hey, we're going to give you the right to purchase those shares, but you got to do it within a certain time frame, right? It's got to be done within 10 years. We can't just let it be for infinity or 100 years, 90 years, 80 years. You got to do it within 10. And the hard part with that is if you forgot about it or if you don't do it and it expires right after that, it's just not yours. It's gone. It expires worthless. So understanding the expiration date is every 10 years. Now, the one thing that you also have to understand is that you're getting granted every month. So your expiration date for each granted option is going to change over time. So using our example, we got granted on 1/1/2019, 10 shares, great. Then let's say we got another 10 shares on 2/1/2019. That means for that granted share option, we have 10 years from that grant date, which would be then essentially January 31st of 2029. That would give you a full 10-year period. So it's extremely important to understand. That also plays into when we talk about valuation, which we'll hit in a few slides from here, but it's definitely a good thing to know. The next one really has to do with taxation and your gain. And again, I'm not going to try to bore you too much, but it really is important to know. So the bargain element is your exercise price minus the price of the stock at the time you decide to exercise. So we're going to use our example. We are granted 10 shares on 1/1/2019 at $100 per share, which means that we have the ability, we have the option, right? We have the right to purchase 10 shares of Netflix at $100. So let's say 2 years later, when the price is trading at $200 per share, to make things easy, that we decided to purchase those 10 shares at $100, but the stock was trading at 200. That means we have 200, the stock price at the time, minus our exercise price, 100. That equates to $100 gain in our stock options, which is fantastic. That means we made $100. So if we take that $100 and times it by the number of shares we exercise, which would be 10, that means we made $1,000. So that is what's called our bargain element. What's really interesting, and we'll get into E-Trade as well, is when you go to your E-Trade portal and you see on, they have that really nice graph that's up and down. That graph is representing the bargain element or your total gain with all of your granted options. So it's a really nice representation of how much you own, essentially gross. So again, we'll get into the taxation piece. So that's the bargain element. It's really important to know. And that lingo is really used in our world. The Netflix really doesn't promote it very much, just within the documentation. The next two pieces really have to do with exercising. You can do what's called a cash exercise or a cashless exercise. It's very, very simple. What a cash exercise means is that we have to bring cash to the table. So using our example, we decide that we want to exercise 2 years later and purchase 10 shares at $100 per share, which is going to cost us $1,000. So if we were to do a cash exercise, that would mean that we would need to bring $1,000 out of our own pocket to the table to purchase those. You could also use what's called margin, but we don't need to go into depth there. But essentially means that you have to take money out of your own pocket in order to exercise those options. Cashless is exactly what it means. It means you don't have to bring any cash to the table. I don't want to say it's free to you, but it's just a way that you don't have to take money out of your own bank in order to purchase these options. You can actually use your gain to be able to purchase those options. So to not go into too much depth, 99.9% of the time, cashless exercise makes sense. There are a select few people in this world that probably could bring cash. And if you really were curious on why that would make sense, I'm happy to go in depth at some other time. But really doing the cashless exercise really makes a lot of sense. So that really is, it rounds it up for the terminology. Hopefully that all made sense. And just remember our example, because we'll hit on that a few other times in a few slides.
So you all got all of that? It is a lot. We can go back if there's any questions about what any of those mean again, feel free to use the chat feature. We're happy to talk about it, or feel free to ask at the end. Let's give Tim just a chance to catch his breath after all of that. And what we're going to do is we're going to dive into some of the basics, right? So really more of the functionality that revolves around doing this. So,
yeah.
It
looks like, Dan, that we had somebody chime in and ask if there was any penalty to doing cashless exercise. No, there is no penalty. I mean, essentially what you're doing is you're using the gain in your stock in order to purchase those shares. So let's say that you had the 10 shares, right, that you wanted to purchase, and you brought $1,000 to the table. You then would purchase 10 whole shares. But if you wanted to then do a cashless exercise, instead of receiving 10 shares, you're really only going to receive, let's say, 5 or whatever it may be. I'd have to do the calculation, but you then receive only 5 shares instead of 10 shares. Now, again, you're going to say, well, doesn't it make more sense to bring cash to the table? No, it really doesn't. If you really run the numbers, again, cashless exercise makes sense. To do the one big reason why you would want to do a cash exercise is to really have more ownership of shares. That's really is a difference maker. So to give a small example, if you're a startup company and you had options and you wanted to control the company, then I would argue that doing a cash exercise makes sense. So you're not giving up control of number of shares. That's really is why a lot of people want to do the cash exercise.
Thank you, Tim. I'm technically the co-host of this, so it's possible, Tim, that maybe only you might be able to see those questions. So,
got it.
Sorry, I'm going to have to throw more on your shoulders to watch that. Thank you for
That's
asking the question. So the basics, yes, we'll get to the chicken scratch piece. Tim was not an English major, but it will make sense. So as we mentioned, E-Trade, if you're hunting around your Fidelity Net benefits for these pieces, you're looking in the wrong place. And really E-Trade is what holds this. We're going to touch more on that, but that's the platform you're using for your options. Tim has mentioned taxation quite a bit already, and as Ben Franklin so eloquently put it, there are two things that you can be certain of, right? Death and taxes. That is definitely going to be a big impact when it comes down to what we're looking at here when it comes to your stock options. And so I'll pause there, actually, if Tim has anything he wants to add about taxation.
Yeah, I will admit to all of our listeners that I have probably the roughest job. I'm going to bore people to death who wants to talk about taxes. But at the same time, it's extremely important to understand. So what I did is my chicken scratch here, which I will admit I have handwriting of a third grader. I just went through and kind of gave an example of how these non-qualified stock options are taxed. So to very simply put, the way that these are taxed is they're going to be taxed as income, and not just income, but W-2 income. So it's really going to almost be like compensation to you. And the reason why that's an important distinction is because if it's going through your W-2 wages, you're going to then have to pay taxes on, employer taxes, FICA, FUTA, Social Security. It's essentially just like you received a salary payment. So there's going to be a little bit more taxation than if it was running not through W-2 wages. AKA it's heavily taxed, especially in the state of California, just because state taxes are a little bit higher than other states in the United States. So to kind of give you a brief understanding of how the taxation is going to work without the nitty-gritty details, is what I have here is we start from the top, which I'm going to get my little laser out so people can follow, is like in our example, we received 10 shares, right, on January 1st, 2019. And then 2 years later, we decide that we want to exercise our shares. And the stock price, SP, is $200 at that time. So what we have the right to do is to purchase 10 shares at $100, right? So that means we can go ahead and purchase 100 shares or 10 shares at $100 at that time. Then what we can do, because we know this information, we can create our bargain element. We know that 100 shares times 10 equals 1,000, which is 100, where I got to the 100 is 200 minus 100 is 100. So our $100 gain times the amount of shares that we have equals $1,000 of gain. That's going to consider our bargain element, which means that that's going to be considered the compensation that is going to then have to be taxed. So to make things very simple, and I'll come back to this, I just said, okay, let's say that we had a 50% tax. So then what you do is you take your $1,000, you times it by 50%, and you get what your net return is going to be, which is $500 in your pocket. Now, 50% is actually a little bit high when it comes to the taxation. If you're actually going through E-Trade, E-Trade is going to actually withhold a certain amount of your gain, and ask how you want to go about it. But that number is actually 41.7%. The reason why we use 50, and when we usually talk to our clients, we say 50, is it's just a really easy number to understand what you have after taxes. Because again, in E-Trade, when you see your amount, you're going to see your gross gain, essentially lop off half of that, and that's what you own. The rest of it's going to be going to taxes. It is extreme, it's a lot, but the free amount, quote unquote, again, I don't like to say free because it's really part of your compensation package, is you're just not paying anything for it. You're just going to then, it's like a bonus, really, in a sense, is how I would look at it. So the taxation, again, is W-2 income, and it is going to be taxed. It's extremely important to know this. Let's see, hold on, we have a question. Does the benefit value in E-Trade account for that, or is it that pre-tax? It does not account for it. It's gross. So it's pre-tax, you are correct. So it is pre-tax, the value that is being shown. It's really important, important to know that, because people will see it and then they'll be like, oh man, lop off 50%, and that's really what's going to be in your pocket at the end of the day. The other thing too is, and not to get into too much detail, but this taxation is really important because of income. Now, we've had some clients that, loved Netflix, but decided to move on to other opportunities at different companies, and they've received different types of stock options, maybe incentive stock options or RSUs. And it's really important to know, because you're vested immediately and you can carry these over, is understanding how those are taxed relative to other options that you may have in the future date is really important, because there are some tax strategies that you can apply and that you can really run depending on the level of income that you are making. And it also is important to know, because let's say, for example, that you're with Netflix, you're making a high salary, but then, you decide that you're done with it and you want to go back to school and your income is going to jump off a cliff, right? It may make sense to delay the exercise until you actually aren't receiving the income. I should also make a note that the income will be applied in the year it's exercised. So if you exercise it in 2019, for that tax year, it's going to be considered income to you. It really kind of rolls into also election periods. So the election periods are really important, because this really has to deal with supplemental options, the allocation. And what that really it means is, when can you elect to defer your salary to the supplemental allocation? Typically speaking, with Netflix, you're looking at anywhere from November, December timeframe is when they come out and they'll notify you, say, hey, it's time to elect how much you want to put towards the supplemental plan, and then you can go there. What's important to note is that, number one, once you make that election, you can't take that election back. So if you decided to defer, let's say, $50,000 into the supplemental allocation, what Netflix is going to do is they're going to spread that out over 12 months. And you can't retract it. You can't say, oh, just kidding, I don't want to do that anymore. So it's set in stone, it goes, and then you can re-elect for the next year. So that's important to note. The other thing that's important to note is that the supplemental allocation, and Netflix does a good job detailing this in their documents, is that it actually reduces your gross income, which can affect your 401k contributions and potentially some insurance aspects as well. So it does trickle down into other aspects of somebody's financial package and what's kind of going on. So that's something also just to note. I'm going to let Dan hit on some different plans that we see with other employers, just kind of comparing it to Netflix.
Yeah, so as we mentioned earlier, Netflix is very unique in what they offer to you. More commonly, if we were to look at some, for lack of better terms, we're going to call them peer organizations. We understand Netflix enough to know that may not be the case really with a lot of these, but nonetheless, other organizations that we find ourselves involved in typically offer things like ISOs, which we won't get into what that actually is today, or RSUs, which is not options, it's actually restricted stock units. We find that to be a lot more of a common practice at entities like Amazon, Dell, Facebook is a big example of that too, Apple. So although Dell does offer some non-qualified stock options too, it's not typically found. So that is a very nice, unique piece to Netflix, that if you do end up going somewhere else, or you've come somewhere else, then it can be kind of confusing though, because that is so different. So we want to make mention of that. That is, I think, why we see a lot of confusion about what that looks like here. So there are some resources that Netflix does provide that we do want to just draw your attention to. Some of you maybe have seen them, some maybe not. But there's a link here on the slide. We can also provide this to you later if you want to. Like I said, we're going to send you this video, but there's a video inside of that does a really nice job. It was well put together. Who would have thought, right? But it's still very confusing. It begs to ask some, even though they do a really nice job, it does beg to ask some questions that aren't answered. And hence why we're here and why we take the role we do with people individually. You also, though, do find some spreadsheets. Now, a number of people have found the video, but don't really get to dabble much in the spreadsheets. So we're going to take a bit deeper dive, and this is about as deep of a dive as we're going to take today into those spreadsheets so that you can see a little bit as to how they function. And so I'm going to pass it back to you, Tim, if you can take us on in.
Yeah. So I'm just going to pull up the first spreadsheet, which I won't spend too much time on, which is the option tracker. And before I get into this spreadsheet that they've put together, which is really nice, the video does, like Dan mentioned, does a great job at explaining the basics behind the plan and understanding the logistics and how it functions. Outside of that, it doesn't do much, but it is good if you really just don't understand it. So I just wanted to highlight the video and kind of explain where you can get some information there. The first spreadsheet is an option tracker, and really what Netflix did is it provided obviously the employees to be able to track the supplemental as well as the free options over time and what's been granted. You can track the price. You kind of have to enter in the data yourself. It's just a nice way to track it if someone's a spreadsheet geek like myself. It's really cool. It's fun. But outside of that, I don't want to spend too much time. I just kind of wanted to show that. Just so you know, we got to the spreadsheet in an interesting way, but I'm happy to always pass it along in any capacity. So what I'm going to do is I'm going to jump into a different spreadsheet, which is actually a really nice one also that Netflix has created, and hopefully some people who are watching have seen this one. This is the stock option program modeling tool. I don't want to go into too much depth here, but essentially what this is saying is that what you have to understand is when you do the supplemental allocation, you really need to compare it to, okay, do I want to defer my salary, or do I want to take, after taxes, whatever money I'll get, and then go and buy stock on the open market today, and what makes more sense both from a taxation and a gain perspective. This is what this spreadsheet really does for you, is to see, okay, what makes more sense and why. And again, we're happy to explain this, but I don't want to go into too much depth there. The one piece, and this is kind of, you won't see this with Netflix because we kind of created this ourselves actually just recently. And what we want to go through is, because like Dan mentioned, the supplemental allocation is a really interesting topic, and when should we do it, and what is this 40% discount? We really wanted to show you what this 40% discount really means. And I think Dan really hit it on the head the other day. What the 40% discount is, and like they say in the movie, it's a cost of the options. It's not a discount, but it does provide leverage. So essentially, you can get 2.5 more shares of Netflix doing the supplemental allocation if relative to going out and just buying those shares on the open market. So you get more shares, which means you can provide leverage. But just like with any type of leverage, it can have a really nice positive effect, and it can have a really nice negative effect as well. So I'm just going to walk through this example to show you what it looks like. So really quickly, just bear with me. We have our supplemental allocation, which means we're going to defer $100,000 for the next year. So what this is representing is the amount of money that we're deferring month over month, which is about $8,333. This line here is representing what our grant price is. To make it very simple, I just selected actually what Netflix closed out today, which was $526.27. Every month, that's what we're going to get. This column represents the 40% discount, or the cost of the option, which is how they're going to determine how many shares you receive, which is $210.51, which means for our $8,333, we're going to receive 39.59 shares. Now, not to get too technical, but what Netflix does do is, if you have fractional shares, they're going to round you down, and then they're going to carry that fractional share to the next month. So you're really only going to receive 39 shares, not 39.59 shares. It's a technical note. But just like Netflix explains on the website, that the link that Dan mentioned, in order to really see what your true investment, when you allocated or deferred your salary, how much that is, you really need to add what the grant price is plus the exercise price to really see what the cost was to you, which equates to $736.78. Now, what's interesting about that is that $736.78 is approximately 40% more than what the grant price was to you at $526.27. So in order for you to actually get your deferred salary back, the stock has to rise 40%. Once it hits that mark, all of your deferral salary is now gained back, and then you start making money. So if we take that logic and say, okay, how much have we invested? We have to add up all of this column, which this column is taking the number of shares by this price, which is 29,166. You sum all this up, you've technically invested, or the cost has been $350,000. So then what we can do is we can say, okay, well, if we were to decide to exercise all of these shares at $600, which is more than our grant price, then we're going to receive $285,000 back to us. It means that in all reality, we've lost roughly $35,000 of what we've deferred out because it hasn't reached that mark. Now, if I go here and I say, okay, what if the grant price did hit the 40%? What do I get? You make $350,000, but that $350,000 was the cost, which means that we just received all of our compensation, our deferred compensation, back. So it has to increase more than the 40%. So you're not buying Netflix at a 40% discount. Again, like they say, it's the cost of the option. Now, what we also did is we wanted to show why this is really important, because it shows leverage. So just bear with me. What I did is I went back and I looked at the Netflix price back on August 26, 2010. And then actually this is really like 547 because of when it traded yesterday. I'm just going to do that.
This is going to be wild.
So
we hear this all the time from people.
So that was the closing price on 8/26. The closing price yesterday was like $574 and some odd cents. So over that time frame, a cumulative return of 3,000%, which is nuts. It's crazy. That equates to a 41% growth rate per year in stock price. So what I did is I said, okay, well, what would it take, or what would the price be if it continued to perform like it did in the last 10 years? That means if we would have got these grants and we held it for a whole 10 years, we would go 17,489.37. That $100,000 would equate to roughly a large gain. You would come out with $7.9 million if it were to continue to have the same performance, which again, past performance is no way indicative of future performance. So where it becomes the difference in the leverage really comes into play is this is what it would look like if we just went and bought those shares at the same price. We would have $3.3 million, but we would no way have 7.9 million because we're receiving more shares for it. So Netflix is correct that it is an advantage. You are technically, like Dan mentioned, kind of leveraged there because you're receiving more shares. But again, it really, you have to think, okay, is Netflix going to continue to perform 40% stock price increase year over year for the next 40 years? If it is and you think it, then wow, that's a really, really good return. But again, it's something that you really have to take into consideration. I know that was a lot, but we just wanted to kind of try to beat that myth to the ground and explain exactly how that functions. If you have questions, happy to answer them. It's a little confusing, but that's what I got.
So the reason why we walked through this, besides trying to explain what we find to be one of the largest misconceptions about this 40% deal, is because what we're trying to do is take the first stage of how you think about your options, or how you should think about your options. And obviously this is the numerical piece to what this could be. And yes, indeed, clearly there is some risk and you could potentially take a loss as well. So going through the steps as to what or how you should think about this. Every year at the end of the year, we send out a very lengthy letter that we're going to actually share with you to all of our Netflix clients to help them walk through the thought process. Of course, they can call and talk to us, and most of them actually do, and we're glad that they do. But you're busy people, so you can go through the letter as well too. So we're going to share that letter, and the reason why we're doing that is we're just going to take the highlights of it to walk you through the way that we would generally talk about how you should think now about this from not just a quantitative piece, but also a qualitative piece.
Yep. And, to start this conversation off, is really, we look at things with, again, we always use the analogy of the wedding champagne glasses. We want to fill each cup up. Once the cup's full, it starts spilling to the next cups, and so on and so forth. I do want to hit on, and this is more compliance, this isn't advice. This is more of a way of thinking. It's a framework. So please don't go out and take this and say, oh yeah, I can do it. Work with your advisor, work with your professionals, make sure you understand each step of this framework. But it's a nice way to kind of get people thinking in the right direction about when should I start making this supplemental allocation. So first steps first is to make sure, what's my current annual salary? The reason why we want to understand that is because you're receiving 5% of Netflix stock options per year, every year, for free. It's great. So let's calculate that out and see how much you're receiving every year, because then we can understand what the concentration of Netflix is right off the get-go, because we will be concentrated within that stock. So we want to understand that first. Then the next step is to really start thinking, okay, am I contributing enough to my 401k, or at least meeting the Netflix match? Netflix is going to match your contribution at 4%. Anything over that, they're not going to match you. So we always say to any client that has a 401k, make sure you get your match done, because that's just leaving free money on the table. So if we can check box 1, then we start checking box 2. Good, we are doing our match. The next part is to really start thinking, what are my short-term and medium-term goals? So what cash do I need on hand right now to potentially buy a new house, buy that new car, get a better leased car, save up for a really nice trip once COVID is not a thing anymore. What do I really want to achieve in the next 12 to 24 months? Do I have enough cash flow to save up for those goals? Once we say, you know what, our short-term goals are checked, we move down to the next line. What we do from there is then you say, am I saving enough for retirement? So then you start looking at, okay, I got my short-term goals are taken care of. I'm thinking, all right, I get my free options, that's cool, but am I saving enough to my qualified accounts? what you can do for the IRS is you can at least max out the 401k to 19,500, both in the Roth component and the traditional component. If you really want to get there, that's where we start adding our cash flow to make sure that we get to those levels. And I know Dan's going to chime in and have a comment on that quick.
Yeah. So if you're looking at this, and Tim's going to mention it here too, you can put up to $57,000 a year into your 401k. And I will tell you that I don't think we've seen a single Netflix client that knew that, definitely not taking advantage of it before we started working with them. Many of them do now, but that is something that you have available to you at Netflix. Other entities, other companies can do that too, but that's something that is a nice feature in your Netflix benefits, is that you can technically put that much away into your 401k.
Dan did kind of take my thunder, but he is correct. And essentially, you hit your 19.5, you check that box off. Then, like Dan said, then you ask yourself, am I really saving enough for retirement? Should I be able to max out the 57,000, which includes employer and employee contributions? And that's going into what's called after-tax contributions. Please do not get it confused with Roth contributions. They are different. So then it's like, hey, can I do that? Once we max that out, everything else, all of their boxes are checked. We're good. We're moving to the next. Then we want to re-examine our medium to long-term goals. Do I want to go buy a villa in Italy? Do I want to go and retire early? Do I want to switch jobs? Do I want to start a family, right? It's really start going through more of those medium to longer term goals and understanding what kind of cash that's going to take. If we decide that we're good on all those goals, then all of a sudden we start talking about, all right, how much should we start deferring into our supplemental allocation, and what does that really look like? I know we're going to talk about a few things on what that really looks like, but overall, I think it's a nice framework to think about. Again, this is not the Bible. This is not, hey, this is exactly how it works. Work with your advisor. It's just it's a way to start thinking about when the supplementals can start coming into play with your cash flow.
What basically Tim is talking about, a large part of that is opportunity costs. So part of that thinking has to be, well, where else do, if you put the money into the supplemental options, that's great, but clearly that means that money's not hitting your pocket anymore. So does that actually detract from other things that might be important, right? Like maybe, for example, you aren't maxing out that 401k to the $57,000 limit, and that's a great benefit. Maybe you should be. Or maybe there are private entities, private equity that for whatever reason is attractive to you. Or, I mean, look, the home prices in Los Angeles, they don't come cheaply. So that's, if you're looking at a $1.5 million home, and we would recommend, especially in that area, a 20% down. I know that there are conversations about doing less than that. We'd be happy to debunk some of that thought. But nonetheless, we really like to see people, in most cases, come with 20% down. Well, that's $300,000. So, that takes away perhaps your cash flow to do that, or send your kids to private school, depending on where, what your desires are, and so on. So it does come down to not just the quantitative piece of, do these numbers make sense for me? There is a real value to the qualitative piece of this financial topic, and it does indeed start and lie right here. So that brings us then to a very difficult question, which is, well, when do I sell? When do I exercise these options into stock and then perhaps sell? And so what's funny about that, it always seems to happen right around earnings are going to be released. But we get people that will call us up and say, oh, the Netflix price is here. It's up at this level. Should I be buying more? And then an hour later, we'll get somebody else that will write to us and say, the Netflix price is here. Should I be selling? And I think that's a pretty good example of how you treat this question. It's very, very specific to the individual. There's a lot of reasons that can drive a sell, right? For example, valuation is the first thing on this screen. What we mean by valuation is, we've done our research and we have our opinions as to what we think Netflix is worth compared to what it's trading at. I'm going to repeat that piece there too, what it's worth compared to what it's trading at. There is a value associated with Netflix, and then there's a price in which you find Netflix selling for inside of open markets. Those two don't necessarily equal each other, and they very rarely do. Netflix is either likely trading at a price that's higher than what Netflix should be worth, or the opposite, right? So you probably have your own opinions on that. And as you see the price crater or rise like it has done in the last number of months, you might have a feeling or an opinion as to what the value really should be. And if you can sell those shares at a price that warrants what, compared to the valuation, then that might be a good reason to exercise your options. We've talked a lot about taxes. That's obviously a key ingredient here too. Tim did mention earlier some events that could cause a person to want to sell based on tax reasons. Perhaps you retire. Perhaps you end up leaving this role to go back to school. Perhaps you decide that you want to take the great experience and expertise you have and bring it to a startup concept that has a lot of great value in the future and potential value, but perhaps comes with a smaller salary. In all of those cases, you might find yourself in a situation where you're dropping your income, because keep in mind, when you exercise these options, your income is going to be the consideration when looking at the taxation piece to this. And then, of course, there are goal circumstances that come into play too. Kind of touched on a couple of those a little bit. So these are fine reasons to look at these options as potential cash to achieve goals, such as, again, you find that $1.5, $2 million home, and you need $300,000-$400,000 of cash. This could be a good venue to access to be able to do so, right? Just to give one example of what that could possibly look like. And then, of course, there's one on the screen that I'm going to touch on too, expiration date. As Tim mentioned earlier, you have 10 years. But if you forget about that, even if that stock price has gone through the roof, you're not going to get any of that. So you've got to keep in mind that you need to exercise these before the 10 years, right? That comes into play. 10 years per each grant, right? That's when the clock starts on that. And the piece that was mentioned earlier, I think in perhaps the last slide, that is not on the screen is concentration. And what we mean by concentration is you have a lot of benefits in Netflix, this being a great one. If indeed you don't exercise these and they grow tremendously, you could find yourself having 50% of your net worth tied directly to Netflix. Now, some of you might feel okay with that and some of you may not, but it's definitely something to keep in the back of your head. To what degree do you feel safe, comfortable, happy, whatever be the case, tied to Netflix? Because if you exercise one of these options, maybe that brings you down to 30 or 20%. Maybe that's a better situation for you. Maybe it's not.
And one comment on concentration, I had mentioned this to a friend just the other day who had, their company was providing RSUs, a different option. And I said, let's just look at it like this. Imagine you give us $100,000 and we decided to allocate 90,000 of that into one position. How would you feel about that? Right? You would say, whoa, you guys are out of your mind. That is heavy concentration, which we would also think, yeah, that's really heavy. It's the same thing when you're looking at it for your overall portfolio. And the last comment I'll make about that is these options, a dollar is fungible. A dollar is a dollar is a dollar. It's not funny money. It's not fake money. It's real money, just like the salary that you're making. So you have to look at it as a total portfolio or total piece of your overall portfolio. And then that's where you can determine how much concentration you actually have tied just from a portfolio standpoint or investment standpoint to Netflix.
We have, I believe, one more slide to just go through, and we're not going to go through all of this, just due to time. So one of our clients was so nice to allow us to be able to walk through their E-Trade, but we're just not going to have the time for that. However, if indeed any of you just simply don't know how to do that, feel free to reach out, and we are happy to, that's not advice, just show you, hey, this is what this looks like. That's fine. We can definitely do that. So perhaps, Tim, you can just take a few minutes so that we still have time for questions, just talking about what to expect in this process.
Yeah, E-Trade is a really cool platform. It's very intuitive, but it's also not the best platform either, I'll have to admit. But when you do go in to look to exercise, you're going to go into the exercise tab, and then it's going to ask you a few questions. It's quite simple. You click on the button cash or cashless. That's why we explain the terminology. Again, 99.9% of the time, cashless makes sense. And what it's also going to do is when you go through and you can select, individual grant date, individual grants, different times, all of it, none of it. But it also is going to do withholdings for you. It's automatically going to withhold roughly about 41.7% of your total gain. So that will be done for you. Again, the W-2 impact, we already kind of hit that at length. I'll kind of skip over that, but it will be considered W-2 income, or it will be taxed as such. What you can't exercise. So for example, going back to what we were talking about, let's say you had an exercise price of $100, and let's say you want to go in and exercise, but the stock price is at 90. That means you got a big goose egg. You can't exercise it. It's just going to sit there for another 10 years until that stock price gets above that $100 mark. Once it's above the $100 mark, you're in what's called the money, and then you can go ahead and exercise it. Getting the cash into the account, just so everybody knows, you have two different accounts. You have your stock option account, and then they're also going to provide you with just an individual account where you can then put the stock there. So when you exercise from the stock account, that stock is then, or cash, is then going to move to your individual account, and it's going to sit in your individual account. You can go in and work with E-Trade, and you can tie a bank account to that account. So once the cash is there, then you can push the cash forward. So it's quite simple. Blackout periods, this is really only for select individuals or selected employees at Netflix. It really depends on just where you sit in the corporate structure. But if you do have blackout periods, that means you cannot trade. You can only do what's called cashless exercises, but you cannot sell the stock. So you can exercise, you can own the stock, right? The right to purchase it, but you cannot sell it within these periods, typically around earnings season. And the last thing is just some advisors like ourselves will have access to the E-Trade platform where we can actually help clients through with the exercising, the trading, and all of that fun stuff. But since we're almost out of time, that is all I got. Dan, you can.
Yeah, that's called the limited power of attorney that is at the end of that slide. That's what that's referred to, POA. You can get that. We can supply the sheet if you so actually want, and then have your advisor sign it with you. So that brings us to the conclusion of this. And first of all, we're going to take a second here for some questions, but we want to thank everybody. You've been a very nice audience. Now, I know some of that was out of your control because we stifled you through the mute feature. But nonetheless, what we'll do is we're going to open up for questions here. And I think we probably, it's being that it's a smaller group, just don't get too out of hand, people. I think we could probably unmute if anybody would feel more comfortable asking something where we can hear you as opposed to going to the chat feature. Again, if indeed it's a question that is going to look like individual advice because it's too specific or whatever be the case, we will, we're a Midwest firm, so you're going to get Midwest nice from us. But we're going to politely decline the question and acknowledge it, but decline it and move on. So we'll give a few minutes here if anybody has indeed some questions. And I don't know, Tim, is there anything in the chat feature right off the bat?
Nothing right off the bat. And then I think I asked everyone to unmute. So if you want to unmute and ask questions, you're more than welcome to. I'll just do it one more time, or just the chat feature. If not, then again, thank you everybody so much for listening to us. This is what we like to do on our podcast. We always say, listening to a couple of guys talk about stuff they love. And this is just, what we enjoy. So I know it can sometimes be a little glazy for others, at least my part.
I will mention too, since you just brought up, Tim, that we do a weekly podcast.
Dan, it looks like we did get a question. So the question was, is E-Trade, it says, is E-Trade cash or cashless, or you have both options? You have both options. You can do cash or cashless. It is going to select it. They're usually big purple buttons, and you just say, yep, I want to do cashless, and so allow you to do that. Again, just to repeat myself, if you are in a blackout period, it will not allow you to do a cashless exercise. They will force you to actually bring money to the table, because what they're essentially telling you to do is that you can't sell any stock. So you can exercise your right to purchase it, but it will not allow you to sell it during blackout periods. And then again, I will say 99.9% of the time it makes sense to do the cashless option. But again, make sure you talk with your advisor and anybody to double check what I say, but it's just my personal opinion. No advice.
Yeah, I got a message actually outside that said that people are having a hard time unmuting those that want to. So for whatever reason that is, I'm sure it's a Zoom link.
Looks like we got another question in regards to expiration date, 10 years. What exactly expires? That's a really good question. So I'm gonna break this out into two answers. So first, let's talk about the free options. So you're getting 5% per year on whatever grant date. You have 10 years to exercise your right to purchase those shares at a certain price. So let's say we didn't do any supplemental allocation and you had that right. After 10 years, everything will expire, meaning it will go away. You will make no money. It just becomes what's called worthless. Now, let's say you add supplemental allocation as well. If you don't exercise those as well, or exercise your right to purchase those shares, that will also go worthless, meaning you will not get that deferred salary back. So you just have to be very cautious and make sure you pay attention to the expiration date. And all you're doing, and I guess I want to emphasize this, is you're exercising your right to purchase said stock. And so what you can do is you can exercise it like right at 9 years and 364 days. And then you can just sit in the stock if you want to continue to own it. You don't have to turn it into cash, but you have to actually purchase the stock. Because again, the option is the right to purchase it and own it. It looks like, yeah, I don't know. The unmute function is difficult. Not sure why it's not working. Oh.
Welcome to the new world.
Or you can, I just allow participants to mute themselves if they so choose. Does anyone else have any other questions? Those are really good questions, by the way.
Yeah, they are. I was going to say too that we do a weekly podcast, which you can find on our social media pages or subscribe to. And this week we did a podcast on stock options, of which there were a few things we didn't touch on, like RSUs, ISOs, those kind of things. If you want more information on that, besides you're always welcome to reach out to us individually, you're more than welcome to find some more detailed information we didn't touch on here inside that podcast. It was recorded earlier this week, so we will be releasing it on those pages, I believe, tomorrow.
Yeah. And if you have any suggestions for, let's say we have another question. How do you guys get connected with Netflix from Wisconsin? Dan, I'll let you take that one.
Yeah, so I'll give you the short of it, because that's a longer story. We've been doing this for a long time. I think this is my 16th year or so in the industry, maybe 17 actually. Anyways, we found this firm 5 years ago. Right after we found it, there was I want to give away the individual. So who we refer to now as patient zero or client zero happened to be a friend who was newer at Netflix at the time. And so we ended up working with that person. And then that person was happy enough, right, to introduce us to a few other people. And as we did that, we just took a deeper dive more into understanding the culture, the benefits, and so on. To be quite honest, you are some of our favorite clientele. It just is easy for us to relate to, and a lot of fun things for us to touch on. So that has created a web, and that web has spun now throughout different parts of Netflix. And of course, onward as some people have left and entered into other organizations and so on too. But that's the very skinny as to how that happened. It's a fun question.
Well, I will say though, I'm originally from Salt Lake City, Utah. Dan's originally from Illinois, and technically speaking, our third business partner, Nathaniel, was born in Texas. So we're really not natives to Wisconsin. I mean, I'm becoming a Wisconsinite at this point, but we kind of come all over the place. And our office manager, Ying, she is actually born in Shanghai. And then our financial planning analyst, Darren, was actually, I think, it's the only homegrown one. Only homegrown Wisconsinite, which is from just a town next to Madison, Wisconsin. So it's always fun stuff.
Yeah.
But the Midwest is great if you guys ever want to visit. It's good.
Madison's wonderful. We actually have a lot of Midwesterners that work at Netflix. But any other questions? And if not, again, we are happy to be a resource. Feel free to reach out. If it's a question, it's no problem. We're happy to answer a question for you. If you want to talk more formally, of course, we're happy to engage in that as well too. And we will, again, send this presentation out to you so you have a copy to refer back to.
Thank you guys so much.
Thank you, everybody. Have a great evening.